All right, welcome everyone. We're going to get started right at 12:30 today. While we wait to start, we will have a live Q&A at the end of the presentation. You can post your questions directly scanning this QR code. So scan that QR code. If you have any questions at all, you can go ahead and enter them. If there's a question that you see there that's already been asked, you can upvote it to make sure it comes to our attention. But the way to participate in the Q&A will be through this slide and scanning that QR code.
Great. 12:30 on the dot, Andy. I think we're good to go.
Let's do it.
So, welcome everyone. First quarterly economic and market review webinar of 2026. We've got Adam and Andy here. Lowell will not be joining us today. He is recovering very well from knee replacement surgery on Friday. So we gave him the pass to take the webinar off, but he's sent his best and is recovering well, right, Andy? Is that the
Yeah, that's
latest
right.
update?
Yeah, I just saw him a couple days ago. He's doing well. He's probably attending this webinar right now and screaming at us to get going. But yeah,
No kidding.
he's doing
All
great.
right, we'll keep it moving and try to do our best in his absence. So we'll stick to the usual agenda. Andy, I'm going to pull up the Slido thing real quick, just so people that are joining now know. We will have a Q&A at the end. You can use this QR code and upload any questions you have, and we're going to do what we've been doing, which is address as many of those and usually all of them at the end. So you can go with that, and we'll stick with our normal cadence of just reviewing first, just the general summary of what happened last quarter and also throughout the calendar year 2025. Obviously, the big headline grabber, the third year in a row of double-digit equity return. So coming off the October 2022 bear market bottom, we've had a really strong rally. One of the things we'll do is compare that to prior bull markets and give some context to where we are today. But Q4 of 2025, you saw a lot of the same themes that had played out throughout the year kind of repeat themselves through the quarter. So if you look on the equity side, the US stock market had about average quarterly returns up about 2.5%. Both international developed and emerging markets led the way. That was, again, a big theme of 2025. Um, Recovered strongly from the year. And the bond market, we talked a little bit about the bond market last webinar and, uh, in a lot of client meetings after what happened in 2022, one of the worst bond sell-offs in history. You've seen a little bit of a quiet comeback in fixed income, uh, you know, normalizing back to its mid single digit return levels that you normally see on average. So bonds do still have a role in a diversified portfolio, and last year was a great reminder of why that's still the case. So, Andy, next slide, please. If we kind of look at longer term trends on a 1, 5, 10, 15, and 20-year basis, last year for calendar year 2025, again, the S&P gets a lot of attention in U.S. stocks are the headline grabbers, but international, again, a banner comeback year, up 30+% on developed and emerging markets. There has been, for about 15 years, a continuous lag in the return differential between what happens here and what happens overseas. Last year, that really reversed course. You saw very interesting windows of time. For example, in April, during the whole tariff tantrum, where our stock market almost fell 20%, you had international, emerging, and developed stocks. I don't even think they fell 10%. It was a very quiet reaction to what was a big global headline reaction in terms of the news cycle. But, again, US bond market up 7%, global bonds a little weaker, but great year for diversification. So clients with more balanced portfolios are finally seeing some reminders of why balance is a good thing in the right context. So if we look back, we obviously know the U.S. market strength has continued. There's a lot of questions around, using the bubble word and have we overextended ourselves, and we'll address those certainly in the presentation and in the Q&A with some data. But I think for us, the big takeaway from last year was diversification worked, and another continued strong run for U.S. equities. If we go a little further under the hood, just like last year in general, there's a lot of talk certainly about the Magnificent Seven and how a handful of stocks have continued to perform incredibly well. And certainly some of that argument is justified, and some of that is also really supported by earnings and the size and the strength of these companies. But something that was probably quietly not discussed last year was just the broadening and the strength of a lot of the other sectors in the U.S. stock market. So certainly and tech heavy and service heavy sectors did incredibly well. But you saw things like financials, healthcare, industrials, you know, sectors that normally aren't catching everyone's attention from both a performance perspective, but also from an earnings growth perspective, perform incredibly well. So, for the talk about, we're in a bubble and this is very concentrated to only a few different companies. Again, there's arguments to be made in some of the details, but in general, across the board, earnings and performance was pretty strong across all sectors. You see in the kind of the slightly shaded gray underneath, that is these negative numbers are the intra-year sell-off in each of the sectors. So, for example, tech during the April tariff tantrum sold off almost 30%. So massive whipsaw in tech performance last year. And you see some of the other sectors and what we went through in kind of the back half of Q1, early to Q2 to make for what was a really strong year overall. And next slide here, Andy. One of the things that's incredibly important, and especially with yesterday, I mean, this has been, live and recorded on January 21st. Yesterday, we had the first negative 1% down day for 2026, and also the worst day in the market since October of 2025. And a lot of the things catching the headlines are very similar themes to what we saw last year. Is the U.S. as a global power kind of degrading? Or is there a flight from the dollar? Is there a flight out of U.S. assets? And certainly there's a lot of interesting conversation that's happening around those topics, but we want to continue to emphasize as many ways as we possibly can that what drives stock returns over time is earnings. And if you look at, peel back the different layers of everything you're reading, seeing, and hearing, earnings continue to improve across the board. You're even seeing an acceleration in small cap earnings recovery. So you clearly, on the large cap side, you see earnings growth, but you also see that in the other pockets of the market on both mid and small. So this is really an earnings story. So there's certainly concerns. So it's a crisis of the day we all want to talk about, but if you look at earnings and you look at GDP, you look at the consumer, you look at falling inflation, there's a lot of really great things to point to. I think one of the underreported stories of the back portion of last year was we had a really strong uh, a GDP beat in Q3 and posted in terms of what's projected for Q4. So there's been talk of a weakening economy or a flattening economy, and we're overshooting expectations for economic growth. That coupled with the actual earnings trend, you have to make a really good case of what you're reading, seeing, and kind of fearful about to not feel really good about the general economic conditions at this point. And then the final slide on my end, Andy, before I pass it to you, we've been getting a lot of great questions from clients. It's very interesting working with 1,000+ families. We get a pretty good pulse on investor sentiment and how people are feeling about market conditions. There's been periods of time like 2021 where everyone is very excited about what's happening. You can't take enough risk. You can't the overall fear level is extremely low. People are very excited about what's happening. And you fast forward to today, where economic conditions are better and things are improving. But I would say across the board of what we're seeing with our clients and just the general readings of investors globally is there's definitely a lot of caution and a lot of concern. And, clearly, I mean, the headlines, I think, drive a lot of that, what people are feeling and seeing politically. But in general, when you have this disconnect between how people are feeling and what's actually happening, I would say in general, that's, when you weigh investor psychology into what happens in terms of market movements, that's something probably to feel good about and not be fearful about. So once we see that overexuberance and risk taking go into overdrive, then you might want to think a little bit differently. But for now, we're seeing a lot of caution and a little bit unique because if you look at here, we've got pretty much all of the bull markets that we've experienced coming up on 80 plus years. So a number of bull markets plotted here in their length, how long they lasted, uh, and what the percentage return was for each of these bull markets. And that dotted line through the center is the average bull market run over this 80 plus year period. So about 192% is the average bull market. Coming off of the October 2022 bottom, we're up about 94%. Certainly a lot of strength there, a lot of things to feel good about. Um, but if you compare this, especially more recently, to what's happened since the 70s and going forward, bull markets have been lasted a little bit longer in terms of their duration and performance. So this is not a overstretched in terms of time or return. When will it end? How will it end? And what's the magnitude of the next market move are all things that are incredibly difficult to try and pinpoint and quantify. But with this, kind of middle innings stage that we're in, with all of the great things to point to, um, in terms of the broadening of the market rally here and overseas, other asset classes like bonds starting to pull their weight. I mean, I think the environment for investors today is, overall, positive, right, Andy? I mean, I think it's kind of like the general theme we want to convey here, barring any major surprises. So until those trends really turn on their head and change, balance is good, diversification is good, but a lot of great things to point at in terms of optimism.
Yeah, I totally agree. This has been, it really feels like one of the most hated bull markets that I can remember. Right? I
Hmm.
think there's just like a lot of fear, a lot of the feeling that the other shoe's going to drop at some point. And I think like one of the stories that one of the lessons really to take out of 2025 is those patient investors who can stay calm even, when there is a sense of fear, warranted or not, in the market, tend to be rewarded. And so those patient investors certainly were rewarded in 2025, especially when you think through the volatility that we saw back in April. It reversed itself pretty quickly, but just those patient investors who can stay the course. That's really the formula for investing success. And so what I'm going to do, next is, try to do a little bit more of a deep dive as far as our U.S. equity strategies and how they did. So we saw, from Adam's slide that globally it was a great year. It was really a great year for all asset classes, right? It seems like almost everything, was making money. So that's a really positive year. But let me know if you've heard this story before. Large growth, once again wins the day. It seems like it's been pretty consistent that it's the Mag 7 now. What used to be called what was uh the thing before the Mag 7?
The
What was that?
FANG, FANG.
Fang, yeah, Fang socks. Fang turned into Mag 7, right? But it's like that flavor of companies, right? Those are the companies that have really done the best, it seems like every year, with the only exception of 2022. And that certainly played out again in 2025. It may not have actually played out so much last quarter. So I think some pretty interesting things when we look at just last quarter. Everything was up pretty modestly. Some people like to, think that there's going to be this big Santa rally at the end of the year. It didn't quite materialize as strongly as some maybe would have hoped. But we did see, solid to okay returns in the fourth quarter. But across the board, whether we're looking at large cap stocks, mid cap stocks, or small cap stocks, value had a very slight edge over growth. So I'm not willing to say that this is going to be the end of the big growth phase, that we've seen necessarily, especially when it comes to the mega cap, Mag 7 type companies. But that was an interesting quirk to end the year. But still, seeing 22% 2025 performance out of large growth compared to 13% large value. We're in another one of these years where the market cap weighted S&P 500 outperformed the equal weight version, pretty materially. I think it was like you can see here, it's almost 18% for the cap weighted index versus more like 11 or 12% for the equal weight index, which actually isn't on this table here. But again, if you were invested in the Magnificent Seven, you did well, relatively speaking over everything else that was out there. One really like interesting quirk that I want to point out here. When you see these LG, LV, MG, MV, and all these, right? We're talking large growth, large value, mid growth, mid value, small growth, small value. We're using S&P indices for these. And that's an important distinction because I think one of the things that really, if you try to look at this chart and say, hey, that doesn't make a whole lot of sense, right? It's hard to reconcile. The Russell 2000, right? So we have the S&P who they define what a large cap stock is as the top 500 stocks. The Russell defines what a large cap stock is by the top 1,000 stocks. And so the lower 2,000 stocks in terms of their market cap make up small caps per Russell. And so when you look at the Russell 2000's performance for the year, it was up nearly 13%. But then when you look at S&P's definition of mid caps and small caps, right, we're in single digits. So like, how do you reconcile these single digit returns against this, Russell 2000? And I think one of the really interesting things, one of the differences in indexes, you have to kind of like go under the hood and look at index construction to really get a great sense of what you're looking at. But S&P actually has a quality screen that they place, for any company that actually makes it into one of their indexes. Specifically, these companies have to be profitable. The Russell 2000 has no such requirement. So a lot of companies in the Russell 2000 are actually not profitable. They're money losing companies at this point. And so it's really interesting that this index that has more of these money losing companies did so much better than these indexes that only have companies that are profitable. And a big reason for that is we saw a pretty strong junk rally in stocks. Oftentimes you might hear people talk about junk in terms of junk bonds, but we're going to define like junk stocks as companies that are of lower quality, lower health. Maybe they have higher, debt ratios. Maybe, they don't make money yet. They're unprofitable, companies, right? We actually have a way that we can measure the performance of those companies. You probably, if you've been here long enough, you've heard us talk about our recovery rating that will turn on after big bear markets. And the reason we do that is we know that our stock selection methodology leans heavily on quality, profitability, growth valuations, these things that tend to be a little bit more stable, whereas this recovery rating that we turn on leans into companies that have sold off the most. And the types of companies that sell off the most during a big bear market just tend to be those lower quality companies where there is more company specific risk, right? If a company has high debt rates, if they go through a bad stretch, they could go out of business. Or if they're not profitable, eventually, bills come due and that's going to hurt them long term. But what we saw is those types of companies really did well coming out of the April tariff tantrum lows. We actually expected this, though we do not expect this to be a trend that lasts for very long. One of the things that we talked about in earlier webinars in 2025 is should we turn on this recovery rating, yes or no? We decided against it because the length of time that it took to get to this almost bear market, time in the market, it was really very short-lived, and then it turned around very quickly. And so our expectation is that this junk rally will also be pretty short-lived, relatively speaking. And so that's something that we saw coming out of those April lows. The typical stock, high quality stock that we would look to own in client portfolios was up about 30%. Those more junky stocks were up more like 50% over the course of that year. But I did want to point out, you can just kind of see it visually on this chart. That gold line is those kind of junk stocks, right? They're really, really volatile, right? So standard stock, it's a pretty consistent line. The recovery stocks were just jumping up and going down and jumping up, then going back down, right? We saw this big, downtrend from October through November where these stocks were actually losing money. And then, for whatever reason, December was end of November and December was a pro junk rally kind of time frame again. So we just see this like really volatile signal. And I just wanted to point out that this is something that we actually don't expect to persist for very long. We think that going back to fundamentals, investing in high quality, profitable, growing companies, right? That's going to be where you want to be long term. But this was just like an interesting anecdote of this year that we saw. So it's something that we will continue to watch. And it's not to say that high quality stocks didn't make money. They certainly did. But this will just be something that we're watching closely as 2026 continues. And so getting into a size and style update, in our last webinar, we talked about where we're positioned. We are overweight large cap stocks right now relative to history. And it's in large part because we're in the midst of this really long sort of mega trend that's been favoring large cap companies. You can go back all the way to the end of 2016 to see when this large cap phase really started in earnest. And you can just see from this chart, as the chart goes down, that means large cap stocks are outperforming small cap stocks. There was really only one extended time frame where we saw that trend reverse, and it was the immediate post-COVID time frame where small cap stocks really, rocketed up relative to large cap stocks as the recovery from those COVID lows was happening. But then, very quickly, before 2022 even, we started to go right back into that large cap trend where everything is just, large cap stocks are outperforming everything. So that's something that has been happening. It has continued to happen. One of the things that a lot of people are talking about now is they're trying to find uh, evidence for a small cap rally and when this is going to turn. We do know that we're kind of at the late stage, historically speaking, for us as these large cap phases tend to last. And if you look at the academic research, small cap stocks are expected to outperform large cap stocks. So that certainly has not been the case over the last 10 years. But I'm going to make the argument that this large cap dominance is largely justified. And I'm going to make that argument just because if we look at the earnings that companies have been producing, there's a lot of numbers on this chart. I'm going to ask you to ignore most of them and just look at this column here, right? This is going to be the change of the earnings expectations that analysts had back in January compared to where they were in December. And what you'll notice is analysts were a little bit optimistic heading into 2025 across the board. So whether it was a large cap stock, a mid cap stock, a small cap stock, none of those companies lived up to the pretty lofty expectations that were put on them and analysts back in January. But what you'll see here is large cap stocks only underperform those expectations by about 3%. So, not much of a miss there at all. But when you go down to the S&P 400, that's the mid cap companies, the miss was 16%. When you go down to small cap companies, that's the S&P 600, the miss was 25%. So for whatever reason, these mid and small cap companies just have not been able to generate the earnings that they need to justify a true breakout. And so this is really the main reason why we've seen this large cap dominance. These large cap companies are just absolutely incredible at making money, especially the biggest companies. They've just been growing at extraordinary rates for much longer than could reasonably be expected, and they just have continued to be very successful. So this is going to be something that we're watching closely. Quite frankly, we would love it for the mid caps and the small caps to join the party, right, and start meeting those expectations. But until we see evidence of that, until we see momentum, we're going to stick to that large cap overweight where we currently find ourselves. The other thing that you'll hear people say a lot, well, these stock returns have been so great, but valuations are historically pretty expensive. And the reason they're saying that is the historic PE ratio, so price to earnings ratio of the S&P 500 is about 16. This is one of those ratios where the lower the number, the better. But right now for the S&P 500, it's about 26. So it's about 10 points higher than the average. If you look at mid caps and small caps, the average PE is somewhere in that 17 to 18 range as well. But it is a little bit lower, right? We're seeing the mid cap S&P 400 at about 20, the small cap S&P 600 at about 22. So a lot of people are saying, well, look at the valuations, right? Things look cheaper with those small caps and those mid caps, relatively speaking to large caps. But I think that misses a big part of the story. Um, I, Valuations, don't exist in a vacuum. There's all sorts of other factors that will come into play. And so there's a couple of reasons why I don't think looking back at a historic PE ratio and whatever the long-term average is really makes sense today. These companies, especially some of these S&P 500 companies, they're just incredibly profitable, far more profitable than companies were maybe in the 90s and the 80s and 70s. And so that does justify higher ratings. You also have lower interest rates than you had in a lot of those periods, especially going back to the 70s and 80s. And so lower interest rates can also justify higher PE ratios. And you're just seeing a lot more free cash flow from these companies as well. So it's not just like paper earnings that they're making and there's no cash flow coming in. They're actually generating extraordinary amounts of cash. So, these higher valuations can persist for quite some time. There's no law that says, just because a valuation is high, stocks have to fall, right? And so, the fact that we have PE ratios here, you'll probably read some people use that as a sign of caution. I'll caution you that valuations by themselves are just a really poor predictor of stock market returns. You really need you have to factor in valuations, sure, but you also need to factor in momentum. And right now, as Adam pointed out, momentum in stocks, whether it's the US or international, are actually quite good. So I wanted to point this out, just because it's a little bit more nuanced and sometimes the headline numbers make it seem. And for now, this large cap phase seems to be in place. And I'm not sure that it's really going to stop anytime soon. So the other piece of our strategy, we want to lean towards large caps and small caps, sure, but the other piece is we want to lean towards growth versus value. And so this chart looks very similar to the chart that we just saw about large cap stocks versus small cap stocks. The key difference is value had a run in 2022, whereas small caps had a run in 2021. But otherwise, this looks very similar, right? We're kind of in this mega trend that's favoring growth companies. This is true in the large cap space. So what we're looking at here is large cap growth versus large cap value. And it's certainly been the case that large growth is doing well. A big reason for that is these Magnificent Seven stocks. 6 of the 7 of them currently have a strong buy rating based on our numbers, which suggests that these truly are, unicorn type companies. The thing that's truly impressive about all these names is they're so big, right? And historically, when companies have gotten to the scale of these companies, relatively speaking, they struggle to continue growing. That's not been the case for the Apples, the Microsofts, the Nvidias, et cetera, right? They continue to grow at these extraordinary rates. Right now, it seems like the AI trend is what's driving it, but there always seems to be some storyline and some trend that's driving it. And so that, again, isn't really changing. So these companies are just incredibly profitable. They grow incredibly fast. And, really for some of them, the valuations actually don't look that extreme. Certainly, there are examples where you have pretty extreme looking PE ratios, but, for the most part, they're in the 20s and 30s. It's really not that expensive, just given how profitable these companies are and how much they're growing. So we're still in this phase long term where we think large growth is likely to outperform large value. I think the really interesting thing is, though, when you go down to those small cap stocks, the trend is actually the opposite. So we talked about this in our last webinar that we are kind of bifurcating now our style targets. We're in the large cap space, we're favoring growth, and in the small cap space, we're favoring value. And you can see that here because this line moving up, that is evidence that we're in this pro value market phase. So it seems like, when you look at value companies, once you get under those large companies, those value names are really the ones that are doing well right now. I think sometimes can run counter to people's thoughts on, what might be happening with the AI trend. Certainly the mega companies are loading up on AI, but so are smaller companies, right? They're smaller players all the time. But to me, it's really interesting that value company is really outperforming there. So it's not a huge part of our strategy at this point because we're about 80-20 large caps to small caps, but still, when it comes to small cap companies, we are leaning value and that trend seems to be well established. So with that, we wanted to get to the Q&A. So we had a lot of great questions. I'll remind everyone again, if you want to participate in the questions, please take your phone out and scan that QR code you see on the screen. You can get your questions in. I'll say, we always ask for questions ahead of time. And the big trend that we got this go round is a lot of people are focused on international stocks and how international companies have done. So I want to start here with this one. I'll highlight at the top. And the question here is, can you talk about your international strategies, right? Do we suggest ETFs or managed funds for that, or do we do it directly? I think is the implication there. And so, yes, our area of expertise is U.S. equity investing. So when it comes to buying and selling individual stocks, we'll focus that in the U.S. markets. We are testing an ADR strategy, but it's not ready for prime time yet. So at this point, what I would say is that we do utilize funds to access international markets. And the reason we do that is some of these large fund companies, they have armies of analysts who are boots on the ground in some of these, countries, certainly developed markets, but also emerging markets. And they can transact in those local markets there, right? In India, in China, right? In Germany, in all these places. And they just are able to achieve, I think, better returns by being able to actually be there and kind of understand those markets and those businesses and those cultures a lot. And so we spent a lot of time here at Bernie doing our due diligence on these funds. We want to make sure that the funds that we invest in truly are giving you that exposure internationally, but also doing it in a smart way. Which means following the academic literature on where the stock premiums are, small cap value, profitability, things like that. But we do utilize funds for that space, and it's been highly effective. The funds that we use, for international exposure really have done well. And Adam, I know, you're a big part of the financial planning and the asset allocation discussion. Do you have any thoughts as well as far as, using funds for international exposure?
Well, I think, one of the things I wanted to highlight in general is just why invest overseas. We emphasized this even when, the US was continuing to dominate in terms of performance. But if you look at the global stock market, there's tens of thousands of individual companies that trade globally. If you look at their market capitalization weight, about 60% of them are here in the US, but
Mhm.
40% are outside of our borders. So a tremendous volume of the world's investment opportunities are outside of the U.S. and there's pros and cons to weigh, right? Our economy, in terms of its strength, and the companies that we have here domiciled in the U.S. are incredibly attractive. So we still favor our markets over others, but there's a lot of great things to point to overseas. And I would just say our stance is that, if you think about your stock allocation, we believe somewhere between 70 to 80% of that stock allocation should be domestic, and then there's room for, 20 to 30% of that to be international. So thinking of it more in terms of how it fits into your asset allocation is really important.
That's a great point. And I think that's a great point from a long-term perspective. But, we've got a question here about the short term as well. So specifically, are developed foreign markets a better investment in the short term? What do you think?
This kind of goes back to what drives stock returns and over medium and long term it's earnings. In the short term, a lot of it's noise. So to say with any degree, there's been head fakes in terms of international outperformance relative to US. I think 2017 is the last time this really happened on a calendar year basis. But a lot of things can happen within a 12-month window. There was a lot of noise last year, and both U.S. and overseas markets did incredibly well. Um, Markets tend to ignore headlines and noise. Policy is incredibly hard to predict. There's nothing to say what's going to happen and when at this stage in the game, or what the magnitude of any policy changes are going to be. So I would say always zoom out and think about what makes foreign markets attractive. And it's really a couple things. You get diversification through other currencies, you get diversification through other economies, and access to some of the biggest businesses in the world. That's the driver of why it fits into your portfolio to whatever degree that is. And then whatever happens in the short run, I mean, this stuff's going to bounce around. And think of it like a game of a ping pong. It'll be a back and forth.
Yeah, I agree. And I think a big part of that, the policy part of that question that was doing the heavy lifting there was really the question about tariffs, right? So I mean, I don't think the tariff issue was obviously shocking to markets in 2025, especially around April. But it's not gone away and it probably won't go away, right? So we're gonna have to talk about tariffs probably at least for the next few years. And so the question, that I think a lot of people have is how well will overseas investments perform given the threat that tariffs are going to continue? We're kind of seeing it now, right, with what's going on with Greenland and US-Europe relations and the suspension of trade deals and things like that. It's part of the reason why we saw the volatility earlier this week, right? And that one day that was the worst since October that you talked about. Um, the interesting thing to me about tariffs, like if you'd come into the start of 2025 and you told me what the tariffs were going to be, I would have assumed that international stocks would have had a really tough go relative to the US. But, you made this point already, but in April, when the US stock market was down so much, it was actually among the worst performing stock markets in the entire world. And international stocks had held up far better, even in the face of tariffs. So I don't think there's necessarily a one-to-one correlation here, which is going to be tariffs tank international markets. What we've seen, I think by and large, is tariffs are they're certainly higher than they were. At the start of 2024, for example, but they also aren't something that is so high that it's completely causing international trade to stop. We're continuing to see economic growth do well. We're continuing to see US stocks grow. We're continuing to see international stocks grow. These tariffs are kind of more of a negotiating ploy, quite frankly, versus something that has real economic consequences, at least to this point. So to me, I think that's going to be the story. That's what's going to continue. If the tariff talk does ramp up again, you're going to see short-term volatility. I just am highly skeptical that's going to start, some long extended bear market. All right, and so getting sort of into geopolitics a little bit, I touched on this in my answer there, but there's a question about Trump's threats towards Greenland and how that might impact the market. So, there's no question that there seems to be a lot of chatter about the U.S. acquiring Greenland one way or the other. This to me, and I'll see if you agree with me, Adam, falls into the category of distraction when it comes to your investments. I just don't think this is going to be something that's going to have a meaningful impact one way or the other of what the stock market ends up doing. But what say you, Adam?
Yeah, well, there's a short-term and a long-term way to look at this. I mean, the first question you need to ask yourself is how is this directly going to impact consumers and businesses' ability to grow? And I think when you lead with those questions, you can take a lot of things off the fear menu, right? And this would be one of them. We also last April we did a webinar in the middle of the tariff tantrum and the big sell-off. I think you put together and shared this chart about the cycle of how this is always going to go. We're going to throw something out there that sounds very aggressive and very out of left field. And then that's going to be used as a negotiation tactic to cycle things back to something much less egregious than what's being discussed. So that was the cycle we've gone through with tariffs, and we've gone through it even in 2018 and other windows of time as it relates to how Trump handles, international the international agenda, so to speak. The whole Greenland thing, I agree, distraction, maybe a daily volatility driver, but not a market mover.
Yeah, I think so. And economic slowdowns, maybe in Russia, maybe in Iran. You think that'll
What's
have
the
any impact on
GDP
markets?
Of Iran and Russia? Like what? Like if I look at Russia and Iran and their sides, do we need one of our analysts to like live chat this in? Like, what's
Yeah.
the GDP of Russia and Iran? Unfortunately, I don't. If you've got that in
But
your memory bank, good
bigger,
for
or
you. But
I would set the over underline at like the state of New York, maybe.
yeah, yeah, small, right?
Right.
So what happens in Russia and Iran? I mean, I don't know that. I mean, there's been periods of time where these economies have been pretty much closed off from the rest of the world. So I don't think that interesting news, but not going to impact global markets. Not from an investment standpoint.
Great. Yeah. We've got some questions, flying in. We always ask people to ask questions when they sign up. So we get an initial slug of questions there, and then we always get people who are participating in the Q&A. So I was going to jump subjects here, but we've had a couple other great questions come in about international stocks as well. So let me just stay focused on that international topic for now. We got this one. What is the best way to get into international stocks? And what do you recommend it for 2026? I think I know your answer here, Adam, but I'll let you take this one.
Yeah, I mean, well, I think we've hit this, Andy, in terms of, going the fund slash ETF route. When you invest in international stocks, whether it's developed or emerging, I mean, there's definitely different risk factors that come into play, especially in the emerging market. You're trading on exchanges that might operate a little bit differently, less efficiently, less liquid. Trading overseas is just simply a different skill set. Our stance there is very similar to how we view domestic equity investing. So through the funds and ETFs, we utilize in client portfolios. We're investing large cap all the way down to small cap, um, with definitely a bias to profitable companies. So the best way to access those stocks is through these funds and ETFs. And would we recommend it for 2026? I mean, I think our recommendation for investors looking for diversification has always been yes. So for 2026, I'd say yes because that's been the answer the whole way through. And in terms of your stock allocation, to capture an appropriate level of diversification, if you think about your stock bucket, anywhere between 20 to 30% of an allocation overseas could provide diversification and also potential for long-term additional return.
Yeah, you threw out some good numbers there. I think it's something like 65% of the global market cap is US at this point, 35% international. So if you really wanted to be market neutral, with the US to international split, you would set your equity bucket to be 65-35 US to international. I am a fan of accommodating some home bias though. So home bias, that's the behavioral finance jargon term for people prefer to invest in their home country where they live. It's true of the US. It's true of people who live in other countries. Australians invest far more in the Australian stock market than would otherwise be suggested by the market caps. Same thing with Japan, China, Europe, all those places, right? So people just invest in what they know. So I think that like 80-20 split US to international is probably a good starting point if that's something that you're looking to get into.
And that home bias is why we like stocks more than most other investors in other countries, right? Our
That's probably
overweighting,
true. It's,
especially the
yeah,
last 15 years, right?
yeah,
Our
yeah.
our our stock and investing experience has been pretty significant.
A lot better. Yeah, a lot of people say, yeah, now do Japan, right? Japan was famously in this huge, overinflated market, and then it traded sideways or negative for like 20 years, right? So there's always the risk of that. But you're right. We view stocks as a great wealth creation tool because it has been in the US. And we can obviously get into the reasons for that. One of the things that, also is a theme that I've picked up is people asking questions about volatility. So, I think this one just cuts straight to the core. What do you make of volatility in the market? So I don't know if this is in relation to like a specific event, but I'm going to talk about this more generally. I would expect there to be volatility every year in the market. In fact, volatility is the price you pay for the ability to achieve the outsized returns that come with stock investing. So you can't get the excess returns from stocks if you can't stomach the volatility. Those two things go hand in hand, right? You really have to stick it out through the bad times, to really be able to capture the return premium there. So, as far as what I would expect from market volatility from here, a day like we saw yesterday, that should be expected to happen multiple times in a year, right? We'd expect to have probably tens of days where we see a 1 or 2%, downturn in the market in a given year. I'd expect there to be a 10% drawdown about once every year, and a bigger 20% bear market about once every 4 or 5 years, right? So, you're just go. That's the one thing that I can guarantee with investing is you're going to go through these rough patches, and the way you react to them is ultimately going to be the thing that determines how successful you are as an investor. So, I mean, do you have any thoughts to pile on there, Adam?
Well, I kind of, if you think about really post what happened last April, where the VIX, which is essentially the fear slash volatility gauge of the market, spiked. I think it was a historical spike. I think it rose faster than it maybe ever had to a level that was kind of unheard of for how quickly it happened.
Yeah.
From there to the end of the year, it actually it collapsed and stayed low for most of the year, right? I mean, I think especially the back half of 2025, we didn't have many spikes in volatility at all. And this is kind of like turbulence on an airplane where, things are nice and smooth, and all of a sudden you hit a bump and it feels like something bad's about to happen. But it's, like you said, Andy, it's just the shock factor of coming out of a really low volatility window and then having a 2% down day. It's going to feel like that every single time.
Yeah, absolutely. And we got a question on that, right? Like, what do you see for 2026 with the global turmoil and the considerable sell-off from yesterday? That days like that they're just gonna happen, right? It's completely normal to have those days. I would argue it's even healthy to have those days because it means that the market is pricing in risk adequately, right? So I would say that, just because you get a big down day, that's not necessarily the spark for some big bear market. It's just going to happen. And I think specifically what happened, there was the fear that the whole tariff conversation would come back again. I think things had leveled off and the market had got its arms around what the expectations would be with tariffs. And then, with all the news coming out over the weekend, the threat of a trade war coming back was the thing that was priced in by the market. It was previously pricing in a lower probability of that and had to price in a higher probability based on the headlines that came out. But that's just going to happen, and to me, that is a sign of a well-functioning market.
Right. I mean, just like I had shared, in terms of from the October 2022 bottom, we're up 90 some percent. We had a, 2%, dip yesterday, and uh, putting things into perspective, right?
Drop in the bucket.
That's a drop in the bucket in terms of what we've experienced.
Yeah, absolutely. Um, so yeah, so we'll we talk about volatility. When I think volatility, in the stock market, it really pales in comparison to volatility in the crypto market. So we did get a question. We always seem to get a question about, Bitcoin cryptocurrencies. This one is now a good time to invest in Bitcoin. I would say it's a tempting time to invest in Bitcoin, right? Because we saw Bitcoin fall from, being up in the 120s, 130s, in terms of value, 120,000, 130,000. Now it's like 90,000 or less, right? And so, I think a lot of people are tempted to get in there. I would say what I always say about crypto is this is absolutely a speculative asset. You can make a lot of money in it. You can lose a lot of money in it. Anything that you do allocate to crypto, I would suggest that you put an allocation there that isn't going to make or break the bank for you, right? You want this to be something that is you're fine losing. If you make a lot of money, great. If you end up losing, that's fine too. So, as far as crypto goes, we don't really have like any way of modeling what's going to happen. This is an asset class that's routinely has 90% drawdowns, right? That's happened multiple times over its history. That doesn't happen when you talk about like the US stock market, for example. When was the last time it fell 90%? I don't even know if it's happened. Maybe the Great Depression. But in crypto, it seems to happen pretty regularly. So just I would say always be careful when you're thinking about investing in Bitcoin. Normally I like to send these questions over to you, Adam, but I'll spare you the Bitcoin question this time if that's all right with you.
I appreciate it. I'm just surprised at how quiet it was on the Bitcoin front last year. I mean, I think up until I don't know the back half of the year, I mean, it was doing pretty well. It was kind of like a a cratering that happened in Q3 or Q4, but I mean, I think it's been pretty quiet for Bitcoin. Maybe that's a good thing.
It's been pretty quiet, I think, in part because gold has done so well. So there's a lot of people who like have these, pair gold with Bitcoin. It used to be that Bitcoin is digital gold. Now people are saying Bitcoin and gold are, highly complementary of each other because they're kind of like inversely correlated. Bitcoin can do well even when gold's not doing well. When Bitcoin struggles, gold does well. And that seems to be what's happened here recently. During Bitcoin struggles, we've seen gold really do well. So we did get a question here or a comment. Gold stocks seem to be soaring. Any comments on the recent growth as typical central banks tilt towards gold as a conservative hedge? As far as gold goes, it's another one of these things where, it does have a similarity to Bitcoin in the sense that it doesn't produce any income. And so it can be kind of difficult to try to value gold. Gold has value largely because people think it's valuable, right? At the end of the day, that's kind of where the value comes from. Same thing as Bitcoin, right? There are some, minor uses for gold, but a lot of it is just, trying to hedge inflation risk and things like that. Even despite this good market for gold, we actually do not allocate to it or other commodities. In large part because over the long term, you can expect gold to have quite a bit of volatility, almost equity-like volatility, but not have the same long-term return expectations at the same time. So it's lower return, high volatility. It's not as diversifying as you think it is. A lot of people think of it as an inflation hedge. And it really doesn't do as good of a job as you would hope that it does. Stocks are also a pretty good inflation hedge and historically have outperformed gold. So we actually do not have gold in our mix. It's an asset class that we consider for it, but when we do the optimization framework that we do to determine, what are the best asset classes in terms of, hitting different risk levels that are going to maximize risk adjusted returns, it just doesn't make the cut. So I would actually say that, a lot of these returns in gold happen. That's great for the people who are invested in gold. I'd be a little worried about trying to get it on that trend now because this might be one of those classic buy high traps.
Yeah, and I saw some statistic. I don't want to butcher the percentage, but it was something along the lines of some incredibly large percentage of gold's return that it generates over time happens in very, very short windows. So gold will go like decades without making a new all-time high or doing anything, and then all of a sudden, out of nowhere, it'll spike. And in terms of where that fits into the portfolio, I mean, you've got to have iron patience to um to wait that long for something to happen. And that's why a lot of people view it as a trading asset, not a an asset class for a someone really focused on asset allocation diversification because how it operates, in short windows.
Yeah. So be skeptical is what I would say there. All right, Adam. I know you love taxes. We're getting into the start of tax season here. And I know we had the one big beautiful bill change in 2025, and we've done a podcast, we've done a blog post about those changes. So please tell us in 2026, how will tax changes impact both investments, but also just regular people?
Yeah, I like this question because this is one thing, like on the list of things that are just not being discussed as much as I would have expected. This is towards the top. And I think just from going through and doing tax projections for clients over the last 6 months, comparing, 2024 to 25 and 26 and what the tax bill changes are actually doing in terms of the bottom line. There are some significant tax savings coming through from the new bill, mostly through the new salt cap limit, which is, for a lot of people much, much higher, and also for the new senior deduction. Those will be the biggest drivers on top of the bonus depreciation for business owners being extended. I think there's really a lot of cash that's going to hit the system as a result of the tax refunds that will be issued. So I see it in terms of like the investments in the market and the economy being a big positive for 2026. Um, there the big beautiful bill tax changes are being spread out over a couple of different years. Last year, we had the new senior deduction that was rolled out. The salt cap limits were installed. Those were the headline grabbers for most of our clients. This year, a lot's changing on the charitable front. I don't know if these are market movers, but these are interesting things to know for 2026. So if you don't, the standard deduction is ballooned, uh, especially if you're over 65, it's turned into something really significant. But for those that don't itemize and are charitably inclined, you can now deduct 1,000 if you file single or 2,000 if you are married filing joint on your return in 2026 for charitable giving. So those that have been boxed out of itemizing that still are charitably inclined can now get just like we did during the COVID window. I think it was $300 and $600. So we upped that quite a bit. Those that don't itemize can write off some charitable giving, and then those that do itemize simultaneously now have 0.5% of AGI floor until they can start deducting their charitable gifts. So it's almost like we're taking from one pocket, giving to another, where those typically higher income earners that are still working that do itemize have to wait until 0.5% of AGI of gifts have been given to deduct those. But those that are taking the standard deduction get a now $1,000 or $2,000 write-off that they can celebrate on top of the same things from last year, which is the salt cap limit increase and the advanced senior deduction. So those things, I think, especially with was installed last year, it's going to be interesting. I think these are things that, in terms of market and economic impact, it's more cash in a pocket. It's a form of stimulus.
Yeah, absolutely. And you did a great deep dive on this on our podcast, Long Story Short. It's one of the things that we did in 2025 as we launched that podcast. I know a lot of clients on this call, I think, have at least seen an episode. You had a great episode on that where you kind of talked about all the changes that were coming, what changes occurred in 2025, what changes were to be expected in 2026. So I think that's a great resource. Go check out that episode. You can find it. Go on Spotify, Apple Podcasts, any of those sources. Also, our YouTube channel or even our website, burningwealth.com. You'll be able to find the specific episode of that. So absolutely, go check that out. One of the things that, we had a couple more questions come through. These ones came through the Zoom Q&A, and I wanted to make sure that we had a chance to highlight them as well. And these questions I think are a little more thematic in nature as far as, what to expect in 2026. So we had one that was, could some of the reason why small caps underperform large caps be the result of the impact of tariffs having more of an impact on small caps and large cap stocks? So I think there's an element of this that could it's plausible, I would say. I think one of the other things that's really held back small caps is interest rates. So if you just look at the amount of debt that smaller companies are able to go get versus larger companies. Smaller companies have more debt typically than large companies. You think of a company like Apple, Microsoft, Google, right? They have these huge cash hoards, right? So they don't always need to fund via debt, whereas smaller companies don't have those same resources they do. And there was just this wall of debt that's coming due, in like 27, 28, all the way, going out to 2030, where just a lot of these companies are going to have to refinance that debt. And the question is, where will interest rates be when that debt comes due? Right. So if the interest rates, stayed high like they were back at the end of 2022, that could have a real financial impact on the results of these smaller companies because it would increase their cost of borrowing. If rates do fall, that would be potentially a bullish thing for smaller companies. So I think there's an element of that at play. It's just been a pretty consistent trend that we've seen over the last few years where, for one reason or another, small cap companies just haven't been able to achieve the types of earnings that analysts were expecting coming into the year. It just seems to be the trend. So until that reverses, we're going to be a little bit skeptical of seeing a true small cap breakout. The other sort of thematic question we got here was around AI investments. So obviously AI has been all the rage, for 2025. But if we start to see a slowdown there, the question is, how will that impact the markets? I would say that, AI is certainly a big theme. I would say we did see a slowdown in early 2025. A lot of people think of 2025 and it's this bull market, there are tariffs, right? But going back to February, that is actually when the stock market started slowing down a little bit. And it was really driven by these AI names. If you recall the whole DeepSeek thing coming out of China, they're going to have supposedly these AI models and these, they didn't need the NVIDIA chips and they had these high, performing AI models. So the question was, do you really need, the NVIDIA chips? And that sort of tanked a lot of those AI stocks for a short period of time. So from, February until the end of March, that was really the driver of the stock market decline. So I think we've seen an example of that happen, but then the AI trend, it really does show no sign of slowing down. And that just turned out to be a blip on the radar and it came roaring back. So, certainly it's something to watch. I would say that the very big companies right now, they're being driven by a lot of hype. Will some of this be over investment? If they can't end up monetizing that, maybe. But that's probably more of like a long-term risk than a short-term risk. There just seems to be a ton of momentum right now on this AI trend, and it's really hard to see it getting knocked off course. Everyone has thoughts on AI, Adam. What thoughts do you have?
Yeah, well, I think the question really highlights the narrative in the market and the financial media because I think the story that's being told is that AI is really lifting up or propping up most of the index returns. I like the way you framed it, right? It is a story, but it's far from being the only one. And I think I shared the chart on, sector returns, and I also have looked at sector level earnings growth. When you've got double digit earnings growth and things like financials, uh, I think you can fairly say that this is a much bigger than just an AI story. So I think there's two things happening at once, which is why the markets have been as strong as they have. You do have the AI theme, and we're waiting for that to trickle into the rest of the economy. You have AI investment, which last year was substantially greater than the year before. So billions and billions of dollars being tossed into AI for good reason. But on the flip side, you have non-AI related sectors and companies that are performing incredibly well. So behind an economy that's actually getting stronger, not necessarily slowing. So the thing I point to is that like AI is one headline, but there's so much under the surface that's happening that's not nearly as celebrated.
Yeah, it just seems like one of these things where, the US economy has been so strong and so resilient, really going back to the time where we came out of the global financial crisis. There's just been a lot of things that could have knocked it off course, and it just continued to chug along, right? And so, given that US economic resilience, I would keep betting on the US economy until proven otherwise, just as kind of a
Yeah,
default state.
yeah, good point.
All right, so we're here right at 1:30. We try to keep this thing no more than an hour. There's just two more questions left, so we'll hit these questions pretty quick, and then we'll give everyone back the rest of their afternoon. But one of the things that we've been working really hard on is this ETF, right? So we spent the last part of 2025 and the first couple weeks of 2026 really making sure everyone had the opportunity to be educated on this ETF that's coming out and have the chance to participate in investing in it if it was a good fit for them. So we're kind of past that phase now. And the next phase is the actual launch. So that'll be really exciting. The new ETF is coming out on February 5th. So February 5th is the launch date. We had a really successful, I would say, reaction to this. And so we're expecting it to launch with a material amount of assets under management right at the start. So we're really excited about that. One thing I did want to say is we are doing a client appreciation event at Barcelona in Reston Town Center here, just outside of our
In
home office here in
Barcelona,
Reston. Yeah, on February 5th. So for local clients in the DMV
in
area,
Barcelona though.
Barcelona, yeah, the restaurant Barcelona, not Barcelona, the city in Spain. Um, but yeah, we're doing a client appreciation event there to celebrate its launch on February 5th. So if you're a local, DMV client, or if you just happen to be in the area, we'd love to host you there. We do have an RSVP page, so if you're interested in attending, go ahead and sign up for that RSVP. You should have seen that in an email newsletter just this past week, actually. If you have not seen that, you need us to resend it to you. Please reach out to your advisor. We want to celebrate this ETF launch with you. So if you happen to be in town, February 5th, we're really excited to have you. All right, last one here. Adam, if past is prologue, what do you expect in the first quarter of 2026?
Should have worn my wizard hat for this one.
Where's your Magic
Uh,
8 Ball?
well, I want to get in trouble with compliance answering a 3 month market prediction, but like if you look at when I pulled up earlier, the average kind of quarterly return over time for U.S. equities, it's roughly about 2%. 75% of the time, markets are going up, not down. In general, I think most quarters trend in the right direction, barring those very short-term surprises we run into. So, um, I think historical anecdote on this is that markets build on strength, and we're in a period of strength, but things happen just like we saw yesterday. So hard to really pinpoint where we're going to land March 31st.
Yeah, obviously there's a large, number of possible outcomes that could occur between now and then. But I like your point, right? We've been on this, we're in the middle of this bull market. There's been a lot of momentum. I would always err on the side of expecting the market to continue to grow unless proven otherwise. I think the gist of this question, a lot of people are, I think it's a good one. A lot of people are asking themselves if they do have cash on the sidelines. I know some people, have been spooked by the market in 2025 and maybe de-risked a little bit, went to cash, went to money market, and are now trying to figure out, when's a good time to get back in. I would say that if that's, where you find yourself and you're just worried about putting a big slug of cash in the market right before a big sell-off happens. That's always the risk, right? Consider doing what we call dollar cost averaging into the market, where you just do smaller chunks over a pre-specified timeline. That way you can start participating in the market, gains. But if the market does decline, you still have some cash on the sidelines there, to go to use. So it's really a way to minimize regret, right? By doing that. So if you find yourself in that boat, I would say strongly consider start getting some of that money to work and just come up with a timeline to get it all in. All right. Well,
Good
Adam, I
stuff.
really
Well, thanks everyone.
really appreciate you joining. Yeah. Yeah, we wish Lowell all the best with his recovery. We really appreciate everyone joining us today. A lot of great questions. One thing I'll say is, we mentioned this, but Adam and I do a podcast together. And in that podcast, the whole, gist of it is we want to answer the questions that you're asking. So if you ever do have anything that you want to get answered, feel free to shoot us an email, shoot your advisor an email asking that question. It's something that we would love to be able to address even in between these client webinars that we do every 3 months. So, Happy New Year, everyone, and thanks for joining.